Rich Dad Poor Dad author Robert Kiyosaki says that Elon Musk's biggest weakness right now is silver. And there's rumors floating around that he actually might be in the market for a silver mine. Really, really interesting discussion. And I've invited an expert to the topic. It's Rob Kientz of goldsilverpros.com, absolute expert on the silver matter. And I want to find out, Rob, from you at some point during our conversation, like how realistic that statement is. And I'm skeptical. Welcome on the program.
Thank you very much. Yeah, I think for the industrial side of the market, that statement's probably motivated by the fact that the mines aren't putting out as much silver as industry needs right now. I think Silver Institute has that somewhere around 225 million ounce deficit. I have to go back and look at the latest numbers over what industry is demanding over what the mines are putting out. Now, we do have stockpiles in various exchanges and things like that, so we're not completely out of silver. But we're getting a little thin, Kai, to where we've been maybe the last 6, 7, 8 years. And I think that is sparking some concerns about how important is silver to the economy, and will companies eventually need to reach out and source their own silver? No, we've certainly seen this before. Samsung has had contracts with Impact Silver and some other silver companies to get their silver concentrate directly from companies. I know I have friends that are working on developing exchanges which would allow mining companies and manufacturers to connect more directly instead of going through existing markets. So I think that there is some concern about that and some development in the market around how do we better source our silver if you're a company that uses a lot of it. And certainly if you're an Apple or a Tesla or something along those lines that uses a lot of silver in your products, if you're an EV company or electronics manufacturer, military company, even a lot of medical implement manufacturers are going to really need to source their silver from somewhere. So I don't know if they're going to be buying a mine, but certainly people developing exchanges and different ways of people getting access to silver. I definitely see some of that work going on, and definitely it seems as though the manufacturers are getting a little bit more sensitive, at least, to where that silver may come from.
No, absolutely. Seems very sensible. Like you pointed out, Samsung had a relationship with a or with a producer before. Any other talk, any rumors out there? Like I know that Elon Musk, Tesla, not SilverX, Starlink, StarX. What's it called? Gee, why am I stunned?
Starlink, yeah, the satellite service.
SpaceX.
Yes.
My mind was so focused on silver. SpaceX, like, they of course needs a lot of silver, right? So, like, are there any rumors? Like, I haven't seen any off-takes agreements or anything from major silver companies going in that direction. It's all going to the traders, and it just disappears, or maybe even the refineries directly.
Yeah, it seems as though that's what happens. It goes to refineries, comes out in bars, it goes to the normal channels, COMEX, Shanghai, London market, whichever market you're going through. But I have been contacted by silver mining companies who, just in our chats along the way, especially the primary silver producers, because there aren't that many primary silver producers, and there aren't many of them making money at today's silver prices. So the cost and the cost pressures in the economy as far as labor and energy and things have pushed the cost of production for silver producers pretty high. So a lot of them are concerned about the longer term. Are they going to make enough money to survive as an ongoing concern and make enough profit to really keep that company going? Because they'll have to do more exploration and things like that. And there is some concern in the industry that how do I monetize my silver? I've had companies talk about, well, maybe we want to do an option strategy and we actually keep our silver and then people trade some sort of financial option on it, like a financialization. We've heard a little bit of talk about, well, what if we tokenize that silver and we keep our silver, but we do a token, and maybe that token enables the buyer of that token access to silver if they want to, running some sort of tokenized version of the metal. Lots of different options being talked about, but I do think there's concern in the silver mining industry about prices and about how much profit they can make. And certainly longer term, to going back to the supply question there, if we don't have high enough silver prices to entice primary silver producers to build new mines and do new exploration, we're going to be relying upon that. I think it's about 70% of silver that comes as a byproduct of other mines. And if you're running a copper mine and you don't need copper and you shut that mine down and there were silver coming out of it, that silver is the byproduct of that we don't have that silver in the market. If you're running a big mine whose primary product is not silver, then you're not necessarily going to make your mine decisions based upon the price or the demand for silver. And most silver gets produced as a byproduct. So there's a lot of sensitivity for the primary silver miners and how they're trying to figure out how to monetize in a market in which they have very little control over what goes on in price. And a lot of the control over supply and demand is actually not on the primary silver miners, a different part of the market. So I do think the miners have some concerns there. They don't have a lot of control or leverage in the actual price of silver, or and how they operate when that price of silver may get really close to their cash costs, or their all-in sustaining cost of getting it out of the ground. So I do think that's a concern for the market, and should be a concern also for commodities investors as well. Silver price probably needs to rise for us to continue to build these primary silver mines and have that supply ready.
Yeah, I was going to say, my next question was about the silver price to you. Is like,
Mm-hmm.
we're at 21.50 today, extremely volatile. Like, silver shot
Yeah.
up from about $18 to 24. Now we're down
Mm-hmm.
to 21.50. 15% retracement again. Just going back. Like, I'm not a technical analyst, obviously. I want to talk with you about like what's impacting the price of silver here. Why is it so volatile right now? Of course, I'm sure it's trading hand in hand with the gold price to a degree. But when is it going to decouple as well is the question, because we've talked about the industrial use of it as well, right? And you brought up break-even price point for the primary silver miners. 21.50 is darn close to the break-even point for many of those companies. If you given the all-in sustaining costs, meaning if you factor everything in terms of production, meaning also administrative costs and not just getting it out of the ground and actually producing the product, there's a lot more overhead, right? So point is, like, explain the silver price to us right now. What's weighing on it, and why is it so extremely volatile?
Well, the thing about our commodities prices is they're determined on a derivatives market, and that derivative market is heavily paper traded. And most of the players in the derivatives market are doing it for speculative purposes. They're taking an options or a futures position in it. That could be to offset. There is legitimate hedging. So if you're a producer, there is legitimate going to the market and saying, I've got downward price risk between the time I mine that silver or gold and the time it comes out. So I may take a short position on the futures market to protect against that. And that's normal hedging. But most of the trading on the silver market is done for speculative purposes. It's people trying to move contracts around to make some pennies here or there. And yes, some of those futures positions are hedges, but the majority are not. Because if you look at the amount of volume that's traded every day and how many times those contracts are traded every day in and out, you can clearly see it's not. There's so much more of that than silver produced every year. Not that many people need to actually hedge physical silver. So that market moves up and down with expectations on what the futures price will be, not necessarily physical supply and demand characteristics. Now, when you tend to get to a point in which you may not have as much silver available and it gets tight, that can buoy, the amount of traders going into the derivative markets like COMEX in London buying silver, and it can raise the price for sure. So supply shocks can definitely do that. But that derivative trading really determines it. And that derivative trading has caused gold and silver to retrace here, mostly because of the jobs report and other economic factors and the expectations on the Fed's policy. I think investors in the broad market have jumped the gun there. I'm not convinced that the Fed really is going to stop their tightening, and I'm not convinced that the economic numbers look great. And so I think that this temporary euphoria we got from like the jobs report and some retail sales and things we're getting is really not long-term the way the economy is going to go. And so I think what's happened is gold and silver retraced a little bit, and that hasn't stopped the physical demand. I'm hearing from my physical dealers that their demand is still pretty strong. But in terms of where price is determined on that derivative market, it has changed the way in which traders look at that market and how they're pricing silver. I do, think that silver price has to go higher to sustain additional mining. So I think eventually silver's price could potentially decouple from gold. To answer that part of your question, the typical relationship is that gold tends to move first and silver follows, but silver goes up as a higher percentage. It's more volatile and it tends to follow gold. And that typically has been the case mostly because silver and gold at one point in time were money, and most countries either had a gold standard or a bimetallic standard. And so silver has been linked to gold as money for a very, very long time, 5,000 years or so. So it's been important in society also as an adornment. Gold and silver both used in jewelry. So there are a lot of connection points there. But as you pointed out, silver is now over 50% of silver, according to U.S. Geological Survey and Silver Institute, is used in industry and not as investment. So at some point in time, with all of this increasing amount of silver that we need for electric vehicles and solar panels, and as well as all the other things we need, ESG programs, and then regular everyday use for electronics and things, I do think industrial demand is going to continue to go up. And eventually silver may have to decouple because it's used more industrial now than it is as money. And at some point that relationship between silver and gold is going to break. when that happens is probably at the point where we get to a warning sign in the market that, hey, we don't have enough physical silver, and maybe there's a shutdown in trading, or at least a warning put out that physical inventories are low. I think that's probably the impetus for where silver finally kind of breaks free from that traditional relationship it's had to gold as more a monetary asset.
And it's usually triggers a rally up higher as well. You brought up some economic indicators, and I want to take a step back here and to talk about that because silver, gold as well, by the way, has put in a run when the Fed or when the market seemed to sense that the Fed might be pivoting, and that was around early November. Right, that's when we started running. Gold ran from 1615 to close to 1900. I think it was even 1950. I think at some point, but and silver went up to $24. Sort of didn't break through that wall barrier, but a massive rally on for both precious metals. Now that the inflation numbers are somewhat coming down, but they just jumped up again. You pointed that out in your last answer. The relationship between there is like, was the market, and you sort of said the market jumped the gun a little bit. Like, do you want to elaborate on that? It's like, help me understand it, like how silver and gold sort of move with those indicators, because now the market is saying, well, yeah, we were wrong. Okay, let's sell it off again. Like the Fed is not pivoting, or it doesn't plan yet, or it might take an extra month. So I'm not sure why that thesis all of a sudden is flawed that we had before starting in November, because I don't think it's changed in my opinion, but the market thinks it's changed now, and the market has done a complete 180.
That you nailed it. It's the market's anticipation of what the Fed may do that really drives what the market does, and the market tries to price it in ahead of time. That's why when you listen to mainstream media, they're always talking about, is this priced in? Is the market, have they already put it into their prices, into their economic models at the point at which we actually get to the decision, right? And a lot of times that happens, and the market will swing on that. Going back to my comments earlier, I do think that gold and silver jumped up a little quicker than I would have anticipated, because early numbers on Q4 here in the US in terms of retail sales, and consumers are 72% of the economy. Retail sales were down about 1.1%. It looks like we've had a jump in January at 3%, which is good, although January is not normally nearly as retail heavy as the last 2 months of the year are in the United States. So it's good to see a little bit of a jump in January. It doesn't make up for the losses that we had the last 2 months of the year, November, December. So we haven't had the rosiest retail sales. We didn't have the rosiest fourth quarter. And what I said was gold and silver shouldn't jump until we get earnings reports out. And we're getting a tale of two things in the earnings reports. The majority of the S&P 500 is making a little bit of money, but there is about a third of the S&P 500 that's reporting negative earnings, and it's dragged the entire earnings report so far. Collective earnings, I think it's negative 4.3%, according to what I saw on FactSet. We put that on the program. So there's two-tier system right now. Some corporates are doing okay. A lot of them are doing very, very bad. And I think that's pointing to structural areas in the economy in which these companies are no longer doing well because the economy cannot support them. And I think if you take a broader look at the numbers, the economic numbers for the US economy and even for the world economy, they're not great. High levels of debt, interest rates, things like that. Now, as goes inflation, deflation, I think we're in inflation deflation cycle. So I will defer over to Tavi Costa of Crescat Capital, who talks about this a lot. When you look at inflation deflation cycles, and he has great charts out there for anybody who's interested. If you look at inflation deflation cycles, the last one we had in the 70s, 80s, it had 3 rounds. It had inflation deflation, and then a high blow off inflation before it got under control with the Fed. So right now, if that pattern resumes and that's where we're going, there's going to be a lot of back and forth between Fed policy, the economy, interest rates, and things like that. And so there could be a lot of traps along the way, both bull and bear traps about where the economy is going until we reach final resolution. And final resolution is, have we gotten enough of that misallocated capital out of the economy so we can resume on a growth path? I don't think that we have. And so I think there's going to be more cycles coming in terms of inflation versus deflation. I think it's going to cause problems with the supply chain. And I think the Fed is going to look a little schizophrenic here, because they may tighten more at times, they may tighten less at times. And I think they're going to be reacting to what's going on. And then the market's going to react to that. And so that, I think, is where you're going to get a little bit more volatility in asset prices and in markets, more asset price swings as everybody's trying to figure out what's happening. But essentially what's happening is natural economic law is coming back into play. And some of the limits we've reached in our current system, we're reaching. And so we have to have resolution. We have to have resolution with this debt. We have to have resolution with the fact that we're not growing. We have to have resolution with the fact that our balance sheets, our internal balance sheets, need to get better, and that's at every level. That's at the sovereign level, the corporate level, as well as the individual level. And so I don't think sort of the tough times are over, but I do think there are pockets in there where things could look rosy. And so I think as it relates to economic data and gold and silver, you're going to see some fluctuations in price, and that's normal to expect in that market. And I expect this to go on maybe for the next year or two as well.
Yeah. Now, you brought up retail sales, and I find it an interesting one because if you correlate with inflation, the jump in retail sales doesn't make any sense to me. But I'm just looking at a breakdown here. It seems like department store sales jumped up, food service and drinking places jumped 7.2% within that, and vehicle and vehicle parts, which is interesting because those are more expensive items, right?
Yeah.
Is inflation too low, or is the interest rates or are the interest rates too low? Where's in your own personal opinion? Like if Rob Kientz had a crystal ball, where do you think the Fed should take interest rates to sort of like even it out? Because if I look at the 3%, I can't make much sense of it.
Yeah, let's get to where are we actually growing in retail sales? Because yes, retail sales did go up, but when you decrement them for inflation that people are paying for those retail items, did it actually go up? If inflation's higher than retail sales, then maybe we're a little bit more flat than we think. And so I do think that there is some need in the economy. Definitely, when you go to auto parts, to use parts because people aren't buying as many cars, and also there's a shortage of new cars due to chip and supply chain issues. I know when I went out to look for another vehicle lately, I couldn't find what I needed, and so I had to kind of go to the used market, and I didn't end up buying anything. I stuck with what I have. It just didn't make sense to go out there. So yeah, I do think people are going to spend on things that they need to spend on. The higher ticket items are coming down, though. Here in the United States, real estate starting to come down. Uh, People aren't going as much to the restaurants or things like that. Well, I should say in January, there was a little bit of recovery, but last year, we still have not recovered on the restaurant sector, and we're seeing a lot of restaurant closures in my area. So some parts of the economy really haven't recovered as much, and I just don't see where things are super rosy. Now, that doesn't mean we can't have a growth phase. I mean, there are growth phases in bear markets, for sure we could have that. I just don't see a way for us to have a sustained growth phase until we deal, with the debt issues that we have. And I do think there are some mixed signals in the economy, and that's normal when you're going through what I call pseudo recessionary environment, where a lot of it looks like a recession, but you're not quite there yet. This is the type of commentary you get as well. This looks pretty good. That doesn't look good. The structural problems are not great, but there are some positive signs. And then you tend to hit the recessionary phase, which I think is coming. I think most of the big banks have outlined they think that we're going to have a recessionary phase here. So Goldman Sachs and Bank of America and those guys. So I do think that we'll have one. But you can have periods of time at which certain areas of the economy do well or certain statistics do well. But over the long term, those can be like little fake outs. So you'll see increased inflation and then deflation, or you may see an increase in retail sales, but then the next month you'll see an increase in credit card usage. So a lot of it just depends on individual flows in the economy and things like that. But I tend to look longer term, and longer term, the numbers don't look like we're growing.
Yeah. Now, one thing I also look at, because I know the Fed is looking at, is jobless claims. I look in the U.S. and we're at a 3.4% unemployment rate. That's full employment in my book. Okay.
Yeah.
How does that factor in? Because we've been ticking up a little bit. I think we reached 3.7%. Not a big difference, don't get me wrong. But now we're back down to 3.4%. And, with the Fed raising rates, like it seems like Powell wants something to break, right? And jobless numbers is one of the indicators for him that the economy is not doing so well that he needs to step off, slow down the rate hikes. Like, factor that one in, and into the rate hike cycle. Like, how does that factor in?
I think unemployment or employment in general is one of the Fed quote unquote mandates. I don't know really how much they adhere to that, but I know they do look at it as a data point. And yes, the U6 headline unemployment number is 3.4. The problem with that number, however, is that there are a couple of problems with it. The BLS has come out and they have a special page set up on their website to explain this. Their surveys have been fairly inaccurate, which they admit to. And so this past January 2023, they did a one-time massive update to their data set in which they increased population even for past releases. So it wasn't as though they did a seasonal adjustment. They looked at their entire data set and said, we're going to raise employment. And the reason they did that is because they have two surveys. A lot of people don't know this. They have the establishment survey, which is given to companies, and then they have the household survey, which is given to individuals. And on that household survey, it was showing less employment than on the establishment survey. And so what they did was they just kind of evened the numbers out. Now, they didn't really explain their methodology, and they do admit that there are problems with the numbers, and they do admit it's a sample. Both surveys are samples. And so that's why the seasonal adjustments, and that's why they did this periodic adjustment. I'm not so sure I look at that methodology and I have a whole lot of confidence in it, because if you look at ADP numbers, which come out the Wednesday before you get the BLS numbers, the first Wednesday of every month, they've shown a much more pessimistic view, and that's based off of payroll data. Now, again, that's not a complete data set either, but that tends to indicate that the numbers may not be quite as rosy as what the government is saying. And then I think if you look at the labor force participation rate, which is also promulgated by the government, we're down to like, gosh, I want to say 63, 64% in the US.
62.4, I just clicked on it.
Yeah, so the overall amount of employment available to the economy is lower than it was prior to the tech crash and prior to 2008, when we had the mortgage situation in Lehman. So we've never really got back up to full employment. Now, they're willing and able. Are they just not taking the jobs? Is the job mix bad? What's causing that labor force participation to show a different side of unemployment than does the U6 number that we get quoted? I don't know, honestly, but that's something I think, and these are both government numbers, so the government needs to come and reconcile those and say, okay, we reconciled the household and establishment surveys of our own reporting. Why is that different than labor force participation? So it depends on what government statistic you look at as to what picture you get about the economy. I don't know that those numbers are 100% correct. So I kind of look at those a tad with a grain of salt, and more so, I depend maybe a little bit less on that now, and maybe a more other factors in the economy in terms of interest rates, debt levels, and things like that. The unemployment numbers to me seem to be a little bit less reliable, I guess.
If you had the Rob Kientz Fed Watch tool, what would it predict with what certainty over the next, when the next Fed meeting is? I think it's early March. What do you predict, and where do you see things headed? Like, if you had a close crystal ball, like, how much further is the system or is the Fed going to take things?
Well, I hate to give any specific predictions because we'll always be wrong. It's like you got a 1 in 1,000 shot of getting this, but I will say the direction we're headed. I think we're in a deflationary period in this inflationary environment, much like we had in the 70s, where you had a buildup of inflation, the supply chain reacts, people react with their budgets and their spending, and then you have a deflationary period. And so I think that deflation's the order of the day. We're going to get probably lower earnings reports on the corporates. We're starting to see that. Remember, going back to what I said in the FactSet article, about 1/3 of companies are really negative, and that's pulling down the overall S&P earnings into the negative territory, even though 2/3 are doing okay. That shows that there are structural areas with that part of the economy, and it shows that the economy is going to shrink a little bit, even though some companies are reporting okay. And so you can't just look at like the US 30, for example, the 30 biggest companies, and get an idea for how the markets are doing. You got to look more broadly. You got to look at different indices. And so I think the Fed's going to watch that closely. It does appear as though they're willing to tighten at a slower rate. They did mention maybe a 1/4 point, things like that. They haven't said that they're actually going to pivot, and I won't believe they're going to pivot until they feel they're ready. If you go back to the old methodology of figuring out when or what interest rates need to be, the IMF and BIS have promulgated surveys that show if you're heading into a recession, you need at least 5 to 6 full interest rate points at the federal funds rate level, at the central bank level, to then ease in a recession to try to help the economy out. So I think the Fed knows we're going into a recession. I think they're trying to get up to 5%. I think when they get to 5%, they're going to reevaluate. Is that enough? Has it slowed the economy enough down? Do we still have inflationary pressures? If we get that next big cycle of inflation, I think they may go back into tightening, but I think they could slow it down here, or even stop and just sit and look at what's going on. I don't necessarily think that they're going to go back to easing. However, I would be absolutely shocked if they did at this point. I think we just have to see what the numbers look like in the economy. They're going to follow it. They're going to follow the main statistics around unemployment, around interest rates, around inflation, around corporate growth and things like that. They're going to follow that, and they'll make decisions accordingly. And then, of course, the markets will move ahead of those rate announcements. So the one thing I can guarantee you is Mr. Market's going to try to price in what they think the Fed is going to say before the Fed meeting comes. And then you'll see if the Fed meeting is not what people expect, then you'll see the markets move the opposite direction right after.
Always does. Whichever way I bet, it's the wrong way anyway. So, quickly fact check myself. Next meeting date is March 22nd, by the way. So,
Okay.
and not early March. 'Cause usually it's early in the month, but this one is at the end of the month. So, quickly, I want to come back to physical, sort of as the last topic of conversation. You hinted at it in earlier answers that your friends at the bullion dealers are still saying, steady interest in the physical, in the bullion. Can you give us a quick update there? It seems like to me that the middle class is sort of holding their chickens together. Where do you see the buying come from, and what does the buying kind of look like? And yeah, how steady is the physical interest?
So if you look at physical buying and selling, that typically in an early stage of a rally goes to people like me. They're gold and silver bugs, people that are interested in the industry already think that they may want precious metals or have been really close to making that decision for a long time. Those would be the early adopters. So the physical demand actually lessened a little bit in January and then came back. The numbers the last 2 weeks apparently have ramped back up. So overall, the last year, if you look at overall demand for precious metals, I think it's been very strong. Certainly, if you look at the exchanges and metals coming off of those exchanges and going back out into the economy, both gold and silver, there definitely does seem to be a little bit of an uptick in investor interest, as well as you had Jim Cramer, one of the big generalist voices, basically stump for gold twice in the last couple of months. And then when you look at the ETFs, GLD and SLV, they're only passive access to that. Unless you're an authorized participant, you can't get the metal. So people go into GLD, SLV, they're generalists going in passive funds and passive investing. And that's a sign that generalists have come in. I think 800 million's come into gold the last 3 months and about 260 or 70 million into silver, the SLV. And that's an indication that there is some early interest in the precious metals. Now, it's nothing like we saw 2 years ago with the silver squeeze movement. It's nothing like that. It's about a third of that movement has gone into silver. So it's not quite the enthusiast movement or any sort of euphoric movement into precious metals, but it is an indication that people are looking at their portfolios. They're seeing risk and they're saying, okay, we need to do something about risk here. Let's put a little bit of precious metals in. But I would warn that these amounts are tiny when compared to the other markets. So there are $1 trillion real estate markets and bond markets and stock markets. So if we actually have any sort of rush into precious metals, you'll see those precious metals prices move very quickly because the gold and silver market are much smaller in those other markets. And while we have had nice generalist investor interest in those markets, kind of helped buoying the price a little bit the last few months, we haven't seen a big rush into it. So we're definitely not in any sort of mania phase, but you do see people coming out and saying, yeah, there's risk here in the markets. Should we go back to gold and silver? And you're starting to see people allocate some money in big names. I said, like Jim Cramer coming out and saying, yeah, maybe it's time to get back into some gold in your portfolio.
Yeah, it's interesting. Like you said, $250 million went into the SLV or into physical silver. The overall size of the SLV is 10 billion. Right.
Yeah.
So it's interesting because even percentage wise, that's not a big move yet. And then of course you quoted all the other like sectors like housing and even the Apple stock. If you compare it to Apple or Tesla stock, there's no comparison in valuations and size. Right. Fantastic. Rob, what an amazing conversation. Really, really appreciate your time. Where do we find more of you? It's goldsilverpros.com, obviously. Where else?
We're goldsilverpros.com. We're on YouTube, Twitter. We just started a TikTok channel. And basically just having a lot of fun. You'll see us at conferences from time to time and then on channels like yours.
Absolutely. Yeah. I just saw your video with your daughter yesterday.
Yeah.
Is she running it for you?
Yeah, she's doing a lot of some TikTok content and short form content for us. And it's a way for us to reach out, we think, to a younger market segment, maybe get them interested in metals. Certainly both my kids are. So I thought, hey, why don't we bring my kids on? And maybe that'll generate some interest in the younger generations.
Keep me updated how that is going. I've always said no to dancing on TikTok and all those things. So let me know how that goes. If you can attract a younger audience to actually put some money into our sector, I might do a dance.
All right, I'll let you know.
Okay, perfect. Everybody else, thank you so much for tuning in. We hope you enjoyed the conversation with Rob Kientz here over at from goldsilverpros.com. We enjoyed having him on tremendously, of course, as well. A super informative conversation. Let me know what you think is happening. Is Elon Musk buying a silver mine? Do you think it's a publicly traded company or is it a private deal? I'm leaning private, if at all, personally. So let me know. Is Robert Kiyosaki right? Is that just a bold claim just to get some views? Just put that in the comments. Of course, there's a bit of clickbait in the title here. We have to make it interesting for you to sign in and watch. And I think that's it from my end. Make sure to follow Rob on goldsilverpros.com. He's also very active on Twitter, and really appreciate your time. Don't forget to subscribe. It's that little square down here on this side. And it from us. Thank you so much for tuning in. We'll be back with lots more. Thank you.